Richard Wyckoff's pyramiding strategy offers a profound pathway to transform modest investments into substantial wealth, not through reckless speculation, but through a systematic, data-driven approach deeply rooted in understanding the market's underlying mechanics. This isn't merely about adding to winning trades. It's a sophisticated method that integrates Wyckoff's foundational market laws and phases to identify optimal entry and scaling points, maximizing profit potential while rigorously managing risk. The true power of pyramiding, when executed with Wyckoff's insights, lies in its ability to compound gains exponentially by aligning a trader's actions with the intentions of the composite man, the imagined entity representing the smart money-driving market movements. By consistently increasing exposure in the direction of a confirmed, profitable trend, and doing so only when the market structure supports continued upward momentum, traders can effectively scale their positions, turning initial small investments into significant returns. This meticulous strategy transforms the often chaotic world of trading into a disciplined pursuit, where every added position is a calculated move, backed by the market's own narrative of supply, demand, cause, and effect. It is a testament to Wyckoff's genius that his principles, developed over a century ago, remain profoundly relevant, offering a timeless framework for navigating market cycles and capitalizing on trends with unparalleled precision. The objective is to scale profits by adding to a position as it moves in a favorable direction, ensuring that each subsequent addition is made from a position of strength and confirmed market conviction. This method is a stark contrast to averaging down, a common pitfall for many traders. Instead, Wyckoff's pyramiding is about averaging up, building a larger position only when the market continually validates the initial trade premise. At the core of Wyckoff's pyramiding strategy lie his three fundamental laws, which provide the analytical framework necessary to identify high-probability trading opportunities and manage positions effectively. Understanding these laws is not just an academic exercise. It is a prerequisite for anyone seeking to implement pyramiding with the precision and discipline Wyckoff advocated. The first is the law of supply and demand. This law dictates that when demand for an asset exceeds its supply, prices will rise. Conversely, when supply overwhelms demand, prices will fall. For the Wyckoff trader, this isn't a theoretical concept, but a practical tool for reading the market's pulse. Demand is evidenced by strong upward price movements on increasing volume, indicating aggressive buying. Supply, on the other hand, is characterized by downward price movements, also typically accompanied by rising volume, signaling aggressive selling. In the context of pyramiding, this law is paramount. Positions should only be added when there is clear, undeniable evidence of sustained demand overpowering supply, confirming the upward trajectory of the trend. This means looking for price advances that are well supported by volume and pullbacks that occur on diminished volume, indicating that selling pressure is light and easily absorbed. A successful pyramiding strategy hinges on identifying these moments of consistent demand dominance, ensuring that each new layer of the pyramid is built upon a solid foundation of buying pressure. Without this confirmation, adding to a position becomes a gamble rather than a calculated strategic move. The ability to accurately interpret the balance between supply and demand through price and volume analysis is what distinguishes Wyckoff's approach from simpler, less robust methods. It requires patience and a keen eye for detail, waiting for the market to explicitly signal its intentions before committing further capital. The second fundamental principle is the law of cause and effect. This law posits that every price movement has a preceding cause that determines the effect or the magnitude of the subsequent move. In Wyckoff's methodology, the phases of accumulation, where smart money buys, and distribution, where smart money sells, are the causes, while the subsequent markup, upward trend, and markdown, downward trend, phases are the effects. The longer and more extensive the accumulation or distribution phase, the greater the potential for the ensuing trend. Wyckoff utilized point-and-figure P and F charts to quantify these causes. By counting the horizontal boxes within an accumulation or distribution range on a P and F chart, traders can project potential price targets for the ensuing trend. This horizontal count provides a tangible measure of the cause, allowing for a more objective assessment of the potential effect. For pyramiding, this law is critical because it helps determine when to initiate and scale positions. Adding to a position is justified only when the cause, a well-developed accumulation phase, suggests a significant effect, a substantial markup phase, is forthcoming. If the potential effect is minimal, the effort and risk associated with pyramiding may not be worthwhile. Therefore, before committing to adding layers to a position, a Wyckoff trader meticulously analyzes the preceding accumulation or reaccumulation phase using P and F counts to ensure the projected upside warrants the increased exposure. This systematic approach ensures that capital is deployed only in scenarios where the market has built sufficient energy to propel a significant trend, thereby maximizing the efficiency and profitability of the pyramiding strategy. It is a powerful concept that moves trading beyond mere intuition, embedding a quantitative element into the decision-making process. The third law is the law of effort versus result. This principle examines the relationship between trading volume, the effort exerted by market participants, and the resulting price action, the result. When effort and result are in harmony, it confirms the existing trend. For instance, increasing volume accompanying rising prices, effort leading to a positive result, confirms strong demand and a healthy uptrend. Conversely, decreasing volume on rising prices, effort not producing the expected result, or increasing volume with no significant price movement, large effort, little result, signals a potential divergence. Such divergences serve as early warnings that the trend may be weakening or that supply is quietly being absorbed. For a pyramiding strategy, this law is indispensable. Before adding any new position, a Wyckoff trader must confirm that the effort volume is consistently producing the desired result, price movement in the direction of the trend. If, for example, a stock is pulling back on high volume, it signals significant selling pressure, indicating that adding to a long position would be premature or even dangerous. Conversely, if a pullback occurs on low volume, followed by a strong rebound on increasing volume, it confirms that the underlying demand is still robust, making it an ideal point to add another layer to the pyramid. This continuous assessment of effort versus result ensures that pyramiding is executed only when the market is demonstrating genuine strength and conviction, minimizing exposure to false breakouts or weakening trends. It is a dynamic filter that ensures each additional investment is made under favorable market conditions, reinforcing the overall robustness of the pyramiding approach. For those eager to delve deeper into the intricate mechanics of market analysis and decision-making directly from the master himself, an invaluable resource awaits. The adapted edition of Richard Wyckoff's classic work, How I Trade and Invest in Stocks and Bonds, offers an unparalleled opportunity. This book provides a direct window into Wyckoff's own methods, strategies, and principles, offering insights into how he approached the market, identified opportunities, and managed his trades. It's not just a historical document, it's a practical guide that illuminates the thought process behind the very techniques we are discussing, including the foundational understanding required for effective pyramiding. By studying Wyckoff's original teachings, adapted for modern readers, you gain a unique perspective on the timeless principles that govern market behavior. This book is a crucial companion for anyone serious about mastering Wyckoff's approach, providing the fundamental knowledge necessary to apply his sophisticated strategies, including pyramiding, with greater confidence and understanding. To explore this essential resource and deepen your expertise, you can find the link in the video description below. Beyond the fundamental laws, Wyckoff's methodology defines distinct market phases, each presenting unique opportunities and risks for traders. Understanding these phases is crucial for optimally applying the pyramiding strategy, as it dictates when to initiate a position, when to scale up, and when to prepare for an exit. The first critical phase is accumulation. This period follows a downtrend and is characterized by a consolidation range where the composite man, large institutional players, systematically absorbs supply from less informed traders. Key characteristics include a selling climax, SC, an automatic rally, AR, secondary tests, ST, of the SC low, and often a spring. A false bearish breakdown below the trading range, designed to shake out weak holders before the true upward move begins. The role of accumulation in pyramiding is foundational. It is where the initial position is established. A trader identifies the completion of this phase, often confirmed by a sign of strength, SOS, a strong upward move on high volume, and a subsequent backup to the edge of the creek, BU, a pullback to the top of the accumulation range, which then acts as support. The spring, specifically, is a powerful potential entry point, as it signifies that the supply has been largely exhausted, paving the way for a sustained uptrend. Initiating a small, carefully managed position at these points, once the accumulation is confirmed, sets the stage for the subsequent pyramiding during the next phase. Following accumulation is the FRA key. Markup phase. The primary period for active pyramiding. This phase is defined by a sustained uptrend where demand consistently outweighs supply, leading to progressively higher highs and higher lows. The composite man is now actively driving prices higher, and the objective of the Wyckoff trader is to align with this momentum. Pyramiding is most effectively applied during this phase by adding new layers to the position on pullbacks or during short periods of reaccumulation. These reaccumulation phases are essentially smaller versions of the main accumulation phase, occurring within an uptrend, where the market consolidates momentarily before continuing its upward ascent. They are identified by tight trading ranges, often on diminishing volume, indicating a temporary pause in demand or a slight increase in supply that is quickly absorbed. Key signals within the markup phase include jumps across the creek, JAC, strong moves above resistance levels, and subsequent tests of the creek, BU, or backup to the creek, pullbacks to these newly established support levels. These tests provide ideal lower-risk opportunities to add to an existing profitable position, as they confirm the strength of the trend and the market's readiness to move higher. Each addition should be strategically placed, always in the direction of the confirmed trend. And critically, each subsequent lot should be smaller than the previous one, forming the classic pyramid structure. This ensures that the overall risk exposure on later additions is proportionally less, protecting accumulated profits. The distribution phase marks a critical turning point and signals the time to cease pyramiding and prepare for market exit. This phase typically occurs after a prolonged uptrend, and is characterized by a consolidation range where the composite man systematically sells off their accumulated positions to less informed buyers. Similar to accumulation, distribution features specific events: a buying climax, BC, an automatic reaction, AR, secondary tests, ST, of the BC high, and often an upthrust, UT, a false bullish breakout above the trading range designed to lure in late buyers before the true downward move begins. The role of distribution in the pyramiding strategy is to provide clear signals to stop adding to long positions and to begin planning for full liquidation. Identifying the completion of this phase, often confirmed by a sign of weakness, SOW, a strong downward move on high volume, and a subsequent last point of supply, LPS, a pullback to the underside of the distribution range, which then acts as resistance, is paramount. Ignoring these signals and continuing to pyramid into a market showing signs of distribution is a recipe for significant losses, as it means buying into the composite man's selling. Instead, a Wyckoff trader uses these signals to protect accumulated profits, transitioning from an aggressive scaling strategy to a defensive exit strategy, ensuring that the gains made during the markup phase are not eroded. Finally, the markdown phase is characterized by a sustained downtrend where supply consistently overwhelms demand leading to progressively lower lows and lower highs. In this phase, the composite man is actively driving prices lower, and for a long-only pyramiding strategy, this means a complete exit from all positions. There is no opportunity for pyramiding in the markdown phase for long positions. Instead, it's a period for capital preservation and potentially seeking short-selling opportunities if one's strategy permits. The goal during markdown is to have fully exited all long positions, ideally at the onset of the distribution phase, thereby avoiding the significant losses associated with a declining market. Understanding all four phases, accumulation, markup, distribution, and markdown, provides a comprehensive roadmap for navigating market cycles. It allows the Wyckoff trader to strategically align their pyramiding efforts with the most opportune periods of market strength, and crucially, to step away or reverse course when the underlying dynamics shift from demand-driven markup to supply-driven markdown. This holistic understanding is what elevates Wyckoff's pyramiding strategy from a simple tactic to a sophisticated, market-tuned approach. The detailed execution of Wyckoff's pyramiding strategy demands precision and adherence to specific rules, transforming the theoretical understanding of market phases and laws into actionable trading decisions. The first step involves defining the initial position. This should always be small, typically representing 1 to 2% of the total trading capital allocated to a single trade. This conservative initial sizing is crucial for minimizing risk, especially since the market's intentions, while clearer after accumulation, are never 100% certain. The entry for this initial position occurs after a clear confirmation of the accumulation phase's completion and the nascent stages of the markup phase. This might be after a spring has been successfully tested, or following a sign of strength, SOS, that breaks above the accumulation range, followed by a backup to the creek, BU, that holds as support. The key is to wait for the market to demonstrate its readiness to move higher rather than anticipating it. A small initial position allows for flexibility and provides a base from which to scale up without exposing excessive capital prematurely. Next is the critical process of scaling the position, which involves adding new lots only to profitable trades and exclusively in the direction of the confirmed trend. The principle here is simple yet powerful. Never average down into a losing position. Each subsequent added position must be smaller than the previous one, giving the strategy its distinctive pyramid shape. For example, if the initial position is 100 shares, the first addition might be 75 shares, the next 50, and so on. This decreasing size ensures that as the position grows, the overall average entry price remains significantly below the current market price, protecting accumulated profits and reducing the impact of any potential market reversals on the entire position. Strategic points for adding positions are typically during pullbacks or short-term reaccumulation phases within the markup trend. These are moments where the market takes a brief pause, often on reduced volume, before resuming its upward trajectory. A Wyckoff trader looks for confirmation of reduced supply, low volume, narrow price spreads during the pullback, and a subsequent return of demand, increased volume on upward price action, before adding another layer. These reaccumulation zones, identified through careful price and volume analysis, offer lower risk entry points for scaling up, as they represent moments where the composite man is briefly consolidating before pushing prices higher again. A cornerstone of disciplined pyramiding is effective stop-loss management. Once the initial position becomes profitable, the stop-loss for that initial position should be moved to the break-even point or even slightly above, effectively eliminating the risk on the first part of the trade. As the trend develops and new positions are added, stop-losses for all segments of the trade are progressively raised. This is not a haphazard process. Wyckoff's method dictates that stop-losses should be placed below key structural levels identified through his analysis, such as below a spring, below a backup to the creek level, or below the low of a confirmed reaccumulation range. These are natural support levels that, if broken, would invalidate the bullish premise of the trade. The use of trailing stops can automate this process, ensuring that profits are locked in as the market moves favorably. However, Even with automated trailing stops, it's crucial to understand the underlying Wyckoffian structural points to avoid premature exits due to minor market fluctuations. The goal is to protect accumulated profits while giving the trade enough room to breathe and continue its upward movement. This systematic adjustment of stop losses is vital for preserving capital and ensuring that a profitable pyramiding strategy doesn't turn into a losing one due to a lack of disciplined risk management. Finally, strategies for profit-taking are essential for realizing the gains accumulated through pyramiding. Wyckoff's P and F analysis provides a powerful tool for projecting price targets, offering objective benchmarks for when to consider exiting the market. These projected targets, derived from the horizontal count of accumulation or distribution phases, serve as primary guides for full or partial profit-taking. As the market approaches these targeted levels, a Wyckoff trader intensifies monitoring for signs of distribution or divergence between effort and result. For instance, if prices are making new highs but on diminishing volume, or if there's significant volume with little price progression, these are warnings that demand is weakening and supply may be entering the market. Partial exits can be executed as the market nears these projected targets, or upon the appearance of the first clear signs of weakness in the trend. This might involve selling a portion of the position, perhaps the last added layer, to reduce exposure while still allowing the core position to potentially capture further gains. The ultimate goal is to exit the market systematically as the composite man begins to distribute their holdings, ensuring that the profits generated during the markup phase are secured before the market transitions into a markdown. This discerning approach to profit-taking is the culmination of the entire Wyckoff pyramiding strategy, transforming theoretical understanding into tangible financial outcomes. In the intricate world of trading where information is abundant but wisdom is scarce, two YouTube channels stand out as beacons for those seeking genuine market insight. For anyone dedicated to understanding the specific methodologies, principles, and strategies employed by the most successful traders, speculators, and investors, Trading Insights offers an invaluable resource. This channel dives deep into the practical application of trading techniques, dissecting the approaches of market legends and providing actionable lessons that can be directly applied to your own trading journey. It's a perfect complement to the detailed strategies we've discussed, providing further context and real-world examples of disciplined market engagement. Concurrently, to truly appreciate the cycles and forces that shape financial markets, one must look to history. Wall Street Memoirs is a captivating channel dedicated to chronicling the historical events, major financial crises, and the lives of the most prominent figures who have navigated the tumultuous waters of Wall Street. Understanding the historical backdrop, the rise and fall of markets, and the timeless patterns of human behavior in finance provides a crucial perspective that enhances one's ability to interpret current market conditions and anticipate future movements. Together, these channels offer a holistic education. Trading Insights for the practical how-to and Wall Street Memoirs for the contextual why. They are essential viewing for any serious trader or investor looking to build a comprehensive understanding of the financial world. You can find links to both Trading Insights and Wall Street Memoirs in the description below to continue your journey of market mastery. Implementing Wyckoff's pyramiding strategy is as much about mastering market analysis as it is about rigorous risk management and psychological discipline. Without these two pillars, even the most sophisticated strategy can falter. First and foremost, a strict risk management protocol is non-negotiable. The cardinal rule of pyramiding is an absolute prohibition against adding to losing positions. Pyramiding is exclusively about scaling into profitable trades that confirm the initial thesis. Any deviation from this principle transforms a calculated strategy into reckless gambling. Before initiating any trade, traders must clearly define the maximum risk per trade, typically a small percentage of their total trading capital, e.g., 1 to 2%. While pyramiding concentrates capital into a single high-conviction trade, it is vital to remember that this concentration increases the risk associated with that specific position. Therefore, diversification should be managed at the overall portfolio level, ensuring that no single trade, however promising, jeopardizes the entire capital base. Understanding that pyramiding inherently increases exposure means that each additional layer must be scrutinized even more closely for adherence to Wyckoff's laws and phases. The objective is to maximize profit potential from a strong trend, not to chase gains indiscriminately. This disciplined approach to risk ensures that even if a trade turns against the trader, the losses are contained and do not undermine the trading account. Equally crucial is discipline and emotional control. The market is a master manipulator of human psychology, and the composite man thrives on the emotional reactions of individual traders. Pyramiding, while systematic, requires immense patience and the unwavering ability to adhere to predefined rules, even when emotions run high. Fear of missing out, FOMO, can tempt traders to add positions prematurely or to neglect stop losses. Greed can lead to over-leveraging or holding positions too long, ignoring clear signs of distribution. By understanding the psychology of the composite man, how large institutions accumulate quietly, mark up prices to attract retail, and then distribute to them, traders can avoid becoming unwitting victims of market manipulation. This understanding allows them to act in concert with the smart money, rather than against it. Emotional detachment from individual trades is paramount. Each decision to add, hold, or exit must be based on objective market analysis, not on hope or fear. Regular review of trade performance and strict journaling can help reinforce disciplined habits and identify emotional biases that might undermine the strategy. Furthermore, Wyckoff's method and pyramiding are adaptable to different time frames. Whether trading intraday, daily, weekly, or even monthly charts, the fundamental laws of supply and demand, cause and effect, and effort versus result remain constant. The market phases of accumulation, markup, distribution, and markdown manifest across all time frames. However, successful adaptation requires adjusting the volume of positions and the intervals for adding layers to the chosen time frame. Intraday traders will need to react more quickly to shorter-term signals, with smaller position sizes and tighter stop losses. Long-term investors, conversely, will use larger time frames, allowing for broader price swings and less frequent additions, aligning with major trend cycles. The core principles of identifying strong accumulation, scaling during confirmed markup, and exiting during distribution remain unchanged, but their application is tailored to the specific rhythm and volatility of the chosen time frame. This versatility underscores the robustness of Wyckoff's framework, making it a powerful tool for a diverse range of trading styles and investment horizons. The key is to maintain consistency in applying the analytical framework, regardless of the chart's scale. In conclusion, Wyckoff's pyramiding strategy transcends the simplistic notion of merely adding to winning trades. It is a sophisticated, systematic approach built upon a deep understanding of market cycles and the intricate behavior of major market participants, the composite man. This strategy represents a powerful synergy between Wyckoff's analytical tools, his 3 fundamental laws and 4 market phases, and a disciplined approach to capital deployment. By meticulously identifying phases of accumulation, confirming demand through supply and demand analysis, projecting targets with cause and effect, and verifying trend strength via effort versus result, traders can construct a robust framework for scaling into profitable positions. The essence lies in initiating with a small, carefully placed initial position, then incrementally adding smaller layers only when the market unequivocally confirms its upward trajectory, all while rigorously managing risk with trailing stop losses and strategic profit-taking, guided by P&F targets and signs of distribution. Mastering this strategy demands not only intellectual comprehension but also unwavering emotional discipline, ensuring that decisions are driven by objective market signals rather than speculative impulses. It is a testament to Wyckoff's enduring legacy that his principles provide such a comprehensive and actionable blueprint for navigating the complexities of financial markets. The consistent application of Wyckoff's methods, combined with disciplined pyramiding, offers a potent pathway to achieving significant and sustainable profits. transforming the art of trading into a science of calculated opportunity. This journey requires diligent study, continuous practice, and an unwavering commitment to refining one's skills. The rewards for those who master this approach can be truly transformative, allowing them to participate in market trends with confidence and precision. For those who seek further inspiration and guidance in the world of trading, particularly regarding the psychological fortitude required to navigate market swings, a newly adapted edition of Reminiscences of a Stock Operator offers invaluable insights. While this video focuses on Wyckoff's systematic approach, the human element of trading, the discipline, the emotional control, and the understanding of market psychology is equally critical. This seminal work, now enhanced with insightful comments and analysis for each chapter, transforms Jesse Livermore's legendary experiences into practical lessons for the modern trader. It provides a unique lens through which to view the timeless challenges and triumphs of speculation, complementing Wyckoff's structured methods with a profound understanding of the individual's role in the market. Reading about Livermore's journey, his successes and his failures, coupled with expert commentary, helps reinforce the psychological aspects of trading, making the principles of risk management and emotional control, so vital to Wyckoff's pyramiding, even more tangible. This edition serves as an essential companion, offering a deeper dive into the mindset required to excel in the demanding world of finance. You can find a link to this updated edition in the description, a crucial step for anyone looking to master not just the mechanics, but also the mental game of trading.